Hey, if you clicked on this video, you are looking for a commodities fund or a commodities diversified fund or a fund which generates income out of commodities exposure. So this is CMCL, which is the fund we are talking about. It is the Global X Enhanced All-in-One Commodities Producers Equity Covered Call ETF. That's a mouthful. So I discussed about a similar fund that is CMCC, which is the non-leveraged version of the same fund in the previous video. You can watch it if you are interested. In this video, I'm going to talk about was this fund a good or bad or disaster because I personally hold this fund. And secondly, I'm also going to talk about my future plan or strategy with this fund. Now, to get things started, the ticker symbol of the fund is CMCL and it's the Global X All-in-One Producers Equity ETF. And this fund was started May 2026. It's fairly new, so hardly 3 months, so not much of history to go by. And assets under management, it's about 27 million. Not a great size, but it's a decent size. And management fee is 0.85. And also one thing to understand, this is commodities and this is a Canadian fund. So obviously the asset size and the interest in the fund is gradually increasing. Like it's not super popular. And in this video, I'm going to talk about these two things. Was it good, bad, or was it a disaster? What happened? And I'm also going to talk about my strategy or why I added this fund. So let's first look at the fund strategy to understand how the fund works. Now, the fund is basically a tool that provides exposure to producers of different precious metals, including energy, precious metals, base metals, and for example, they provide exposure to gold, silver, copper, lithium, oil and gas, and so on. So I can show you a quick glance of the fund. Like here, it shows you you know, the basic reasons to consider this fund. This is from the fund's website. And you can see that they provide you the access to producers across precious metals, energy, and base metals, gold, silver, copper, lithium, gas, natural gas, uranium, all in single holding. So that's the unique selling proposition of the fund. And the benefit is that you get all this exposure in one ticket and one, fund solution, all in one exposure to commodities rather than buying individual commodities and rebalancing the portfolio. You get it all in one package. And apart from that, you also have the covered call strategy, which is used to generate income on a regular basis. This fund actually pays semi-monthly income, which means they pay twice a month. So they pay two times a month in terms of distributions. They are able to do that because they write covered calls, which generates income on a regular basis. Okay, so that's the basic idea of the fund and how it's able to generate the income. Just to give you a quick idea, the management fee of the fund is 0.85%, 85 basis points, slightly higher, but bear in mind that this is a active covered call fund. Active fund meaning that the fund is able to generate regular income. They're able to trade options regularly. The fund managers are writing options in order to protect the capital appreciation and also generate income on top of that. So that's how the fund strategy works. So now we have the basic idea how the fund works, and there is a leverage also, 25% leverage, which means that the fund borrows some capital to enhance its returns. So leverage can be a bit risky because not only it enhances the positive returns, but also on the negative side, if markets go down or commodities go down, you're going to get amplified negative returns as well. So that is something you need to be careful about. So as long as you are investing with knowledge of the risk and you have a medium to long term horizon, you should be fine with the leverage, assuming that it suits your investing style and your risk appetite. Now let me go into the holdings of my own personal holdings into this fund. I hold 70 units of this fund, as you can see on the screen. I just put my numbers so that you'll get an idea of what is happening so far. So this one was launched recently. So my idea was to buy a little bit, quantity at a time and gradually accumulate over a period of time. And since it is new, has a low amount of history and not much of track record, I wanted to go one step at a time. And usually I don't invest in new funds. You know that if you're watching this channel for a long time. But in this case, I wanted to get a small exposure because I wanted some commodity exposure in a diversified manner in the Canadian side, in the Canadian part of my portfolio. So I invested around 70 units. Average price is about 1674 because I bought it at different points of time. So the prices could be different. Like I bought it at $17, I bought it lower than $17, and so on. And the book value is like 1171, 1172 to be more precise. So as of now, like as of the 4th of August, like the price has gone up to 1734, which is favorable, and market value is, uh, 1213, again favorable. So what is happening is the fund has been paying semi-monthly 11.6 cents that you see on the screen, the distribution part. And based on that, these are the distributions I received. So I received like on June 22nd, it was very small amount, like very pocket change. And this is like again in July, it's a very small amount, like $2. And in July 22nd was the third distribution I received around $4.64. And these are my distributions because I invested probably in June. I started and I got three distributions so far. And total earned is like $7.19. But bear in mind that um, during these times when I received the distributions, I had a smaller number of units. Currently, I hold 70, but when I started with just 2 units. And then in July, I bumped it up to 20 units. And July 22nd, I, rose it up to 40 units in total. And currently, I have around 70 units. Like we are in August, early August now. So in August, obviously, I will be receiving a much bigger, much larger distributions. And the price gain so far, like based on the price as of August 4th, $17, the gain so far is 3.6% over 3 months. But bear in mind that during these 3 months, there were a lot of ups and downs. There are times when I was down by 5%, 6%, or even 10%. So take this price gain with a huge grain of salt because it's always going to go up and down. And based on my calculations, and this is hardly 3 months of history. So, one quick disclaimer, this is not investment advice, and the numbers you will look at could be different when you're watching this video. At that time, things could look different. So, take this as a education and do your own research and do your own due diligence before you invest your money. So with that, I did a quick projection just for my curiosity, and this is again estimate and all speculation based on what the future will be. So based on the current distribution run rate, currently the fund is paying 11.6 cents, right? So I multiplied that by 24. You can see that on your screen. Why I did that? Because every month the fund is paying two distributions. So two per month would be like 24 per year. So that's why I did the 24 times of the 11.6 cents. That comes to $2.78. And when you look at the fund price, like even though this looks very small, when you look at the fund price or the average cost, 1674, I'm getting a yield of about 16.6%. I'm very pleased with this kind of yield. You know, any double digit yield would be attractive, especially in commodities where you don't get income or where you don't get dividends or distributions. This is still good, and this is very good because you are getting like 16.6%. And if you are getting like 15 plus percent from this commodities exposure, that's a great option, I would say, in my view. However, even if it is slightly lower, let's say it's 12%, 10%, I would still think that that's a okay kind of distribution to take because this is in addition to the price increase or price gains that you might be seeing. So this is my own experience or performance that I'm sharing. So one question has been answered. This fund has been a decent performer. It has been a wonderful performer. Why I'm saying decent is because there have been times when the fund fell off 5%, 10%. So there is going to be volatility, and you should not just go by the 3 months positive performance and make a decision. Okay. So let's now move to the next part. But before that, I want to show you something very interesting. One thing I like about Global X and Evolve is they provide you more information about their strategy. I will show that here. You look at this on your screen on the right side, on the center of your screen, on the little bit on the right side, you see the portfolio metrics. This is the portfolio metrics of the fund as of June 30. Of course, this is a bit dated. We are in August right now. So they have a coverage of around 35%, which means 35% of the fund is used for the covered call writing. So 35% of the fund will have a kind of a moderate appreciation depending on the strike prices. Now there is a good and bad part of it. I will focus on the good part. Uh, Good part is that you get a decent income on the covered portion of the portfolio, which is about 35%. I'm just taking a round number here, 34.79, but let's take it at 35. So which means that 65% of the portfolio, a major chunk, has the appreciation potential. The 65% of the portfolio can appreciate fully, while your 35% is generating that income. Now that's a positive and very good part of it because you have huge amount of upside potential. But the upside exposure can work both ways. Like if the commodity prices go up, then you get the positive impact of that. If commodity prices go down, then you are seeing the negative impact of that. So that's the pro and con of it. Now the second part is the moneyness. Average moneyness is about 6.87%, which means moneyness basically refers to how far the fund managers are writing the calls. The fund managers are writing the calls at the money, then it would be zero. Like if the fund manager is writing the calls at the current market level, let's say this is the market level, fund managers are writing the call at this level. So that means it's at the money. But in this case, the fund managers are writing calls above the market level. They're writing at a higher level, like higher by 6.87%. So you have a 6.87% on the covered portion of the portfolio. So that's the uh, bigger good news part, is that even though the covered portion of the portfolio has limited upside, you still have that 6% 7% upside on the covered portion of the portfolio, which means that you still have capital appreciation on the covered calls or covered portion of the portfolio. That's wonderful. Even if the calls were to be assigned, or calls were to be exercised, even in that case you get that gain. That's wonderful news. And if those calls are not assigned, and those calls are not exercised, that's double good news because you're going to get that premium into your account. That premium is earned by the fund, and that earning is going to be distributed to you as an investor, and you're getting those distributions twice a month. Again, monthly and twice a month is not a big difference. It's just that the way the distributions are being allocated. Like a monthly fund would pay something close to double of this amount, whereas this fund is going to pay the same distribution in two parts, like on a in two parts at two different times of the month. So it's going to be same thing. Instead of paying $1, they're going to pay 50 cents in you know twice a month. Same thing. But the returns are pretty good because the frequency of the payment is higher, and also they are writing calls and generating good amount of income plus capital appreciation. That's the good news. Okay, so with this, I'm going to go back to the sheet, and now I'm going to discuss my strategy. And uh, you heard about the how the fund works, so you might already get some ideas about how the strategies might be for my case. This is my personal view or my personal strategies. You can have your own you know plan. uh, Not necessary that you need to follow this. This is what I have in mind. The first one is like this is an all-in-one commodity exposure with an income stream. So which means that if I have to have a commodities income on the Canadian part of my portfolio, because this is listed in Canada, so I can have this as my core holding in one of my portfolios. So here I have exposure to metals, precious metals, base metals. energy, oil and gas, and also materials such as lithium, uranium. Why this is important? Because okay, you get exposure to gold, silver, because if the markets are down or if there is any uncertainty, gold prices go up because gold is seen as a store of value. Of course, we can go into the historical significance of gold and so on. But when the main markets are down, the gold is seen as a kind of safe haven. And similarly, you can look at base metals. Those are also in, you know, demand currently because of the electrification of vehicles, and also you have demand from battery makers and some people who are involved in the electrification process, and also you have demand from artificial intelligence centers being built or data centers being built. So that those kind of, areas are creating demand for base metals as well as things like lithium and uranium. So on the right side you see these two things, they are closely related and they have a similar kind of demand drivers. Of course, there will be some nuances or differences, but that's the potential demand that's coming from different sectors. And on the left, energy side, on the left side, energy, oil and gas. This is going to be another sector which is pretty good because you have this long runway of demand for oil, gas, natural gas, and heating oil, etc., from various industries, whether it is shipping, transportation, logistics, uh, and also from other areas, for example, like aviation, and also like because of the geopolitical situation, the energy prices are becoming more expensive, and that is leading to higher profits for oil and gas producers and oil and gas storage tankers and so on. So that's another potential area which I'm investing in. So the idea is to get an all-in-one exposure. Bear in mind that this fund does not invest in agricultural commodities. So that is something to keep in mind. Some people think about agricultural commodities like corn, wheat, you know, livestock, and so on. Like this fund doesn't have that exposure, and for me that is good news because I'm looking only at investing in these type of commodities. At the moment, I'm not considering the agricultural commodities segment. So that's number one, all-in-one commodity exposure. Plus, you're getting that regular income stream. The second part is this fund is complementary to other equity or covered call funds in my Canadian portfolio. So I've just marked it as CMCL in this circle, but I could have other funds. I could have another fund on the other two or three funds, and in the overall pie, CMCL will have a decent portion because I think it's good to have one equity fund, one commodities fund, and probably one Bitcoin or Ethereum fund. This is just an idea that I have in mind, but I have not implemented this idea so far. I have one equity fund which is also doing covered calls, and there is another equity fund which focuses on blue chip companies. I'm not going to mention the names here, but the idea is to have few other Canadian funds complementing CMCL. And when I do some portfolio reveal or something, I'm going to show that in that future video. If you want to watch something like my portfolio reveal or specifics of what I do and how I do it, let me know in the comments below. If I see more comments on that, then there is going to be a video on that for sure. But I need to see that response or interest from your end, right? So if you have interest in looking at my portfolio or my strategies, or looking at what I have, or to get an idea, let me know in the comments below. So with that, the second point is complementing my existing portfolio. The third point is uh, there is a mix of active and passive funds in this portfolio. So when you look at CMCL, it has a mix of active and passive style, holdings. Like the fund managers are doing the active covered calls. They're writing calls, watching the performance of the underlying assets, depending on whether the gold is going up or the energy prices are going up, or if there is an opportunity in lithium or uranium or silver. Like as an individual, you don't have the time to do all that. So an active covered call strategy like CMCL is doing that for you. It is giving you that active strategy without your active involvement. You are holding it passively, but fund managers are doing the active part of the fund management, and they are going out and getting you that income. So this helps in long-term growth of my portfolio. Why I'm emphasizing this in the long-term growth is because I'm not investing in this just for the yield or just for getting that regular distribution. I want to stay invested for the long term. The distribution helps me stick to the investing plan for the long term. But at the same time, I showed you that the fund is writing out of the money covered calls, capturing the upside even within the covered call portion of the fund. Plus, they also have a major chunk of the portfolio which is giving you that full exposure to the upside of commodities, full upside. So combination of that is going to give a significant amount of returns over a period of time is what I'm expecting, because this is not going to give you that flash returns in a few weeks or a few months. But if you look at it from a longer term point of view, like 3 years, 5 years, and so on, it's going to give you a tremendous amount of capital appreciation in addition to the distributions or income that you have already earned. So that's the positive kind of total return strategy that I'm trying to implement here. And I hope that you will, see that in my future videos, like when I cover these funds. So with that, I think I've come to the end of the video. Just to quickly summarize, um, why I added this high yield fund to my portfolio, basically to complement my other holdings. First of all, to get an exposure to the commodities portfolio, complement holdings, plus to get the active covered call income with with a passive holding. And was it a disaster? No, not at all. It has been a great performer so far, and I hope to hold this fund for quite long. And I am trying to complement this with other funds in my Canadian equity portfolio so that it can work hand in hand and provide me steady returns over the long run. I hope you like this video, and this is a slightly different format. And please share your comments, feedback, and other you know suggestions that you have. Thank you. Have a great day. Happy investing.